Welcome to This Explainer. Today, we're putting on our expert investment analyst hats and completely tearing down the thesis for Hamilton Insurance Group. We're strictly using their Q1 2026 earnings data and analyst reports to separate the absolute signal from the noise. Now, if you follow this specialty insurance space, you know it's a wild sector right now, flooded with record capital, but also massive geopolitical risks. So we're going to apply some classic valuation lenses, think Buffett, Lynch, and Graham, to see exactly how Hamilton is navigating these waters.
Okay, let's kick things off with a number that's going to make you do a double take. In the first quarter of 2026, Hamilton posted an adjusted EPS that didn't just beat Wall Street's consensus estimates, it literally shattered them by over 45%. In an insurance market where predictability is basically the gold standard, a beat of this magnitude immediately demands our attention. To figure out what's actually driving this massive beat, here's our agenda for today. A quick snapshot of the company, a deep dive into their Q1 financials, their capital strategy, the objective market risks, and finally, we'll look at the street's consensus ratings.
Section 1. The Hamilton Snapshot. Let's get a quick overview of who they are today. So, Hamilton is a Bermuda-headquartered player underwriting global risks across Lloyd's, Ireland, Bermuda, and the U.S. But look at that PE ratio. They are trading at a highly intriguing 5.2 times earnings, with a market cap of roughly $3.17 billion. If we look at this through a Peter Lynch lens, combining that rock-bottom PE with their historical 24% revenue growth rate, the PEG ratio looks incredibly attractive. For a value investor, that valuation alone screams for a closer look. And management's mindset here is absolutely crucial. CEO Pina Albo is super clear. Their philosophy is all about cycle management. In a market where property rates are actually softening, Hamilton is perfectly willing to just walk away from unprofitable business rather than blindly chasing top-line revenue. This is pure Warren Buffett territory, right? Honest management, prioritizing margin quality, and maintaining a strict margin of safety over reckless growth.
Section 2. Q1 financial performance. Let's analyze the numbers.
Before we get into the weeds, we got to talk about the combined ratio. If you're analyzing insurers, this is literally the holy grail metric. It tells us if the company is actually making money from the core policies they write, entirely excluding their investment income. Bottom line, anything below 100% means they're turning an underwriting profit. And this right here perfectly illustrates the turnaround Hamilton just pulled off. They drove their combined ratio down from a loss-making 111.6% in Q1 of last year all the way down to a highly profitable 89.8% this quarter. Now, to be fair, last year was heavily skewed by catastrophe losses like the California wildfires. This quarter, 0 catastrophe losses. That provided a massive, massive tailwind to their profitability. That stellar underwriting cascaded straight down the income statement, generating $134 million in net income, which is a 65% jump. But here is the real kicker for the Buffett fans out there. A blistering 19.3% annualized return on average equity. High, consistent ROE is the ultimate sign of an economic moat. Plus, they still grew gross premiums by 11.5% by finding smart, targeted growth in casualty and specialty lines. Section 3. Capital, strategy, and growth. Let's see how they're deploying all that capital. Management just made a definitive statement by returning massive capital to shareholders. They paid out a $206 million special dividend. That's $2 a share, and executed a $20 million share buyback in Q1 alone, with another $159 million still authorized. They are aggressively rewarding the owners of the business. Now, on the investment side, they use a really unique barbell strategy for their float. They keep 62% in safe, boring fixed income assets and cash, but they allocate 38% to the Two Sigma Hamilton hedge fund. It's a higher yield play that really pays off when it works. I mean, that fund alone returned 4.3% this quarter, injecting $93 million into their net investment income. Hamilton is also getting super creative with their capital structure. They recently launched what the industry calls a sidecar. Think of it as a vehicle to partner up with outside investors who want exposure to insurance premiums. Everyone shares the risks and everyone shares the rewards. By launching this multi-year $300 million casualty sidecar, Hamilton is essentially offloading some of their premium growth to outside investors over the next few years. Why does this matter? Because it secures a brand new stream of fee income for Hamilton without them having to tie up their own equity. It's an incredibly efficient way to grow. On top of that, they're expanding their addressable market. They just launched a brand new private clients business out of London, tailored specifically for high net worth individuals.
And to make sure it hits the ground running, they brought in industry veteran Jamie Keeney, who has 25 years of experience at Chubb, to lead the charge. Section 4. Market risks and exposures. Time to look at the potential downsides. As Benjamin Graham would tell us, a good defensive investor always asks, what could go wrong? In a messy macro environment, what is actively pressuring their margins right now, and what could potentially threaten that pristine 89.8% combined ratio? First up, old ghosts catching up to the present. Hamilton took a $14 million prior year development charge in Q1. In plain English, they had to set aside more cash for an old claim. Management tied this specifically to the final settlement of the massive Baltimore bridge collapse. The industry loss estimate finalized higher than expected, forcing Hamilton to boost reserves, which added 2.4 points of pressure to their loss ratio this quarter. Also, remember that 2 Sigma hedge fund strategy? Well, rating agency Fitch cautioned that Hamilton's risky assets make up 84% of their shareholders' equity, which is a pretty high concentration. Plus, management openly acknowledged real headwinds from the ongoing Middle East conflict, hitting their marine and political violence lines, combined with a generally softening property pricing market. Section 5. Ratings and Wall Street. Let's check the analyst targets. The major rating agencies remain really confident in the balance sheet, checking a major box on Graham's financial condition checklist. AM Best actually just upgraded Hamilton Select to an A rating, citing strong parent company support. Meanwhile, Fitch affirmed their stable outlook, praising their strong capitalization and diversified growth, despite the hedge fund warnings. When we look at Wall Street's valuation models, the projections are rock steady. The median price target sits at $34 over the next 12 months. With the stock trading around $31.90, that's roughly a 6.6% upside. It doesn't sound like a sky-high premium, but remember, we're talking about a value-priced stock trading at roughly 5 times earnings. Overall, the street consensus is definitively bullish. We've got 4 buy ratings, 3 holds, and 0 sell ratings. Hamilton's recent momentum even secured it a spot on the coveted Zacks Rank #1 strong buy list for May, which is a great indicator of favorable earnings momentum. So let's synthesize all of this. You have to ask yourself, does a nearly 20% return on equity and aggressive shareholder payouts offset the unpredictable nature of global insurance risks? The data shows a company structurally optimized for profit, trading at a 5.2x multiple, but operating in a chaotic world. It's up to you to decide if that Ben Graham-style margin of safety is wide enough for your portfolio. Keep learning, keep analyzing, and we'll see you in the next explainer.